The global energy stage is witnessing a significant recalibration, and the United States finds itself at a pivotal juncture. Recent tariffs on Canada and Qatar have sent ripples across international markets. These tariffs, aimed at protecting domestic interests, have strained relationships. Instead of bolstering energy independence, they might push suppliers to other markets. This shift could lead to a more competitive and uncertain environment for the U.S. The coming months will determine if these changes are temporary or permanent. Former President Donald Trump has voiced significant alarm regarding the current U.S. administration's handling of the oil tariff dispute. He argues that these newly imposed tariffs have backfired spectacularly. Mr. Trump critiques the measures as strategically flawed. He believes these policies undermine America's energy security. Alienating reliable energy partners like Canada and Qatar is a misstep. These nations will redirect their oil exports to other buyers. This risks driving up domestic energy prices. Mr. Trump's statements highlight a belief in robust trade relationships. He points to the potential for these tariffs to weaken the U.S. dollar. His alarm reflects a broader concern about America's core economic and security interests. He sees these actions as creating openings for other global powers. His vocal criticism fuels a domestic debate about American energy stability. In the face of new U.S. tariffs, Canada has initiated a series of calculated moves to diversify its energy export destinations. This strategic redirection is most evident in the increased volumes of Canadian crude oil finding their way to Asian markets, particularly China. The expanded Trans Mountain Pipeline is playing a pivotal role in facilitating this westward flow of energy. The souring of trade relations has accelerated Canada's efforts to cultivate new partnerships. European nations, also keen to diversify their energy sources, represent another significant area of opportunity for Canadian exporters. Canada's vast natural resources make it an attractive partner for countries looking to secure long-term, stable energy supplies. This proactive diversification reflects a longer-term strategic recalibration for Canada. By actively developing new trade routes and relationships, Canada aims to build a more resilient and adaptable energy export portfolio. The message from Canada is clear: its energy resources will find their way to market one way or another. For the U.S., it means that a historically secure and readily available source of oil is now actively looking elsewhere. For Canada, it offers the prospect of new economic growth and stronger ties with a broader range of international partners. This strategic pivot could fundamentally alter the energy landscape of North America and beyond. Qatar, a global heavyweight in the liquefied natural gas market and a significant oil producer, has mirrored Canada's strategic response to the U.S. tariff situation. Faced with new economic hurdles in accessing the American market, Doha has moved decisively to reinforce its existing trade relationships and forge new ones. This pivot is a calculated reaffirmation of Qatar's long-term strategy to maintain its leading role in global energy supply. The Qatari response has involved a concerted effort to secure long-term supply contracts with key Asian importers, such as China, Japan, and South Korea. By locking in these agreements, Qatar guarantees outlets for its production and strengthens its economic and diplomatic ties across the Asian continent. Qatar is also looking to bolster its presence in the European market. As European countries continue their efforts to reduce dependence on Russian energy supplies, Qatari LNG presents an attractive alternative. The imposition of U.S. tariffs on Qatari oil could inadvertently provide Qatar with an even stronger incentive to focus its marketing efforts on capturing a larger share of the lucrative European gas market. This strategic redirection by Qatar has significant implications for global energy dynamics. For the United States, it means that a key Middle Eastern energy supplier is actively prioritizing other markets. Qatar's ability to swiftly pivot and secure alternative export destinations demonstrates the limitations of using tariffs as a tool to control global energy flows. Qatar's proactive engagement aims to insulate its energy sector from the vagaries of U.S. trade policy. The redirection of oil exports by Canada and Qatar, spurred by U.S. tariffs, has sent tangible economic tremors across the United States. One of the most immediate consequences has been a reduction in the oil supply available to the U.S. market from these traditional partners. This tightening of supply has contributed to an upward pressure on domestic oil prices. American consumers are feeling this at the petrol pump, and industries reliant on petroleum products are facing increased operational costs. The transportation sector, for instance, is directly affected by rising fuel costs, which can then translate into higher prices for goods and services throughout the economy. Similarly, manufacturing industries that use oil and its derivatives as feedstock or for energy are experiencing a squeeze on their profit margins. This economic strain comes at a time when many businesses are already navigating other inflationary pressures. Beyond the direct impact on prices, the situation has created a climate of uncertainty within the U.S. energy sector itself. Refiners who were configured to process specific grades of Canadian crude may now face challenges in sourcing suitable alternatives at comparable prices. The broader investment climate in the U.S. energy infrastructure might also be affected, as uncertainty over future supply chains and trade policies can deter long-term capital commitments. The current situation serves as a stark reminder that in an interconnected global economy, actions taken at the border can have profound impacts far beyond the customs posts. Canada's response to the shifting trade landscape extends beyond simply redirecting existing crude oil flows. It involves a significant strategic focus on developing its liquefied natural gas, or LNG, export capabilities. This is particularly evident on Canada's west coast, where major projects are advancing. The Shell-led LNG Canada facility in Kitimat, British Columbia is a flagship example, nearing completion and expected to commence operations later in 2025. This multi-billion-dollar venture is designed to ship Canadian natural gas to Asian markets, representing a long-term commitment to diversifying Canada's energy export portfolio. Further illustrating this trend, Total Energies recently signed a significant 20-year agreement to purchase 2 million tons per annum of LNG from the proposed Ksi-Les-Sims LNG project, also in British Columbia. As part of this deal, the French energy giant acquired an equity stake in the project's developer, Western LNG. Such investments underscore the international confidence in Canada's potential as a major LNG supplier. However, not all Canadian LNG ambitions are progressing as smoothly. On the East Coast, Quebec's GNL Quebec project has seen renewed discussion in light of U.S. tariff threats, yet its viability remains highly questionable. Reports from May 2025 indicate that the project's cost estimates have ballooned, potentially exceeding $23.8 billion US dollars. Analysts also point to challenges such as high construction costs and potentially reduced European gas demand in the long term. This mixed picture for Canadian LNG development highlights both the opportunities and the obstacles. Qatar stands as a titan in the global liquefied natural gas market, leveraging vast reserves and state-of-the-art infrastructure. Its geographical proximity to key Asian markets offers a competitive edge over U.S. exporters. Shorter voyage times and lower costs make Qatari LNG more attractive. As new production capacity comes online, competition will intensify. Qatar's strategic position ensures it remains a central player in the global LNG market. A critical element in Canada's strategy to diversify its oil export markets is the Trans Mountain Expansion project. This recently expanded pipeline system now provides significantly increased capacity for Canadian crude oil to reach tidewater at Burnaby, British Columbia. From there, tankers can transport Canadian oil to various international destinations, most notably across the Pacific to Asian markets. This development is a game-changer for the Canadian energy sector, offering a vital alternative to its historical reliance on pipeline networks that primarily feed into the United States. Indeed, a notable shift has already occurred, with China emerging as the largest buyer of Canadian crude oil shipped via the expanded Trans Mountain pipeline. The ability to access Asian markets directly provides Canadian producers with greater leverage and more options. The Trans Mountain artery is not just a pipeline, it is a strategic conduit for Canada's economic sovereignty in the energy sphere. The increased flow of Canadian oil to Asia via the Trans Mountain system has direct implications for the U.S. market. Historically, much of this Canadian crude would have been destined for American refineries. With a growing portion now heading west, U.S. refiners may face increased competition for these barrels or need to seek alternative sources of supply. The strategic importance of the Trans Mountain pipeline expansion cannot be overstated in the context of current global energy dynamics. This pipeline is a key enabler of Canada's pivot, allowing it to navigate the complexities of international energy trade with greater autonomy and market reach. The United States must consider strategies to safeguard its energy security and maintain market stability. Re-evaluating tariff policies and engaging in diplomatic negotiations could restore stable oil trade relations. Expanding domestic energy production, especially LNG, is crucial. Strengthening energy alliances and investing in innovation can reduce vulnerability to supply shocks. A blend of domestic policy, diplomacy, and trade relationships is essential for reliable and affordable energy. As we look to the horizon, the future of global oil markets remains both challenging and promising. Emerging technologies, such as renewable energy and electric vehicles, are set to redefine energy consumption patterns. While oil will continue to play a significant role, diversification into cleaner energy sources is inevitable. Gap 2S. International policies will increasingly focus on sustainability and reducing carbon footprints. Countries will need to balance economic growth with environmental responsibilities, making strategic investments in green technologies. Gap 2S. The geopolitical landscape will also evolve, with new alliances forming around shared energy interests. Nations that can adapt to these changes, leveraging both innovation and cooperation, will be better positioned to thrive in this new era. Gap 2S. The U.S. must continue to evaluate its role within this shifting paradigm, ensuring that it remains a key player in the global energy market. By embracing change and fostering international collaboration, a sustainable and stable energy future is within reach. Gap 2S. Ultimately, the path forward requires a blend of visionary thinking and pragmatic action. The journey towards a resilient and diversified energy market is complex, but with strategic foresight and global cooperation, it is a future worth striving for. As we pivot towards renewable energy, the global energy market is undergoing a seismic shift. Gap 2S. Solar, wind, and hydroelectric power are no longer fringe technologies. They are now central to the energy strategies of both developed and emerging economies. Gap 2S. Investments in renewable infrastructure have skyrocketed, with countries like China and Germany leading the way. Gap 2S. This transition not only promises a reduction in greenhouse gas emissions but also fosters energy independence and economic resilience. Gap 2S. For the oil industry, this shift presents both challenges and opportunities. Gap 2S. Companies are increasingly diversifying their portfolios, investing in renewable projects to hedge against the volatility of oil prices. Gap 2S. The integration of renewable energy into the grid is also driving advancements in energy storage technologies, making it possible to store excess energy generated during peak production times. Gap 2S. Governments play a crucial role in this transition, with policy frameworks and incentives accelerating the adoption of clean energy. Gap 2S. For instance, the European Union's Green Deal aims to make Europe the first climate-neutral continent by 2050. Gap 2S. Similarly, the Biden administration in the U.S. has set ambitious targets to reduce carbon emissions and promote renewable energy projects. Gap 2S. The ripple effects of these changes are being felt across industries, from transportation to manufacturing. Gap 2S. Electric vehicles are gaining traction, and companies are rethinking supply chains to incorporate sustainable practices. Gap 2S. In summary, the shift towards renewable energy is not just a trend but a fundamental transformation of the global energy landscape. Gap 2S. As nations and industries adapt, the future holds the promise of a cleaner, more sustainable world. Gap 2S. The journey is complex, but with innovation and collaboration, a greener future is within reach. Gap 2S. As the world embraces renewable energy, policy changes are reshaping economic landscapes globally. Gap 2S. Governments are implementing stringent regulations to phase out fossil fuels, incentivizing green energy projects, and promoting sustainable practices. Gap 2S. These policies are not just environmental imperatives, they are economic catalysts that drive innovation and create new market opportunities. Gap 2S. For instance, carbon pricing mechanisms such as carbon taxes and cap-and-trade systems are compelling companies to reduce their carbon footprints. Gap 2S. This not only mitigates climate change but also spurs the development of cleaner technologies and energy-efficient processes. Gap 2S. Subsidies and grants for renewable energy projects are making it financially viable for businesses to transition to sustainable energy sources. Gap 2S. However, these policy shifts are not without challenges. Gap 2S. Industries heavily reliant on fossil fuels face significant economic disruptions. Gap 2S. Job losses in traditional energy sectors are a pressing concern, necessitating robust retraining programs to equip workers for roles in the emerging green economy. Gap 2S. Additionally, the cost of compliance with new regulations can be substantial, particularly for small and medium-sized enterprises. Gap 2S. On the flip side, countries that proactively adapt to these changes stand to gain a competitive edge in the global market. Gap 2S. For example, Denmark's aggressive investment in wind energy has not only made it a leader in renewable energy but also a major exporter of wind technology. Gap 2S. Similarly, South Korea's Green New Deal aims to create over 1.9 million jobs by 2025 through investments in green infrastructure and technology. Gap 2S. In summary, policy changes in the energy sector are driving a profound economic transformation. Gap 2S. While the transition poses challenges, it also presents unprecedented opportunities for innovation, job creation, and sustainable economic growth. Gap 2S. As nations navigate this complex landscape, the role of effective policymaking cannot be overstated. Gap 2S. With the right strategies, the global economy can not only survive but thrive in the new era of renewable energy. Gap 2S.